Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Academy's weekly podcast, where we'll provide all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, and in today's show, we're going to be speaking with MAI Appraiser and MH industry expert, Chuck Schierbeck. Chuck is a senior valuation specialist with Colliers International and is the foremost expert in commercial property valuations, including preparation of appraisal reports, supply and demand analysis, financial and site feasibility, and overall market examination. More specifically, Chuck is nationally recognized for his work within the manufactured housing niche. Now, in addition to his expertise in the MH space, he also has extensive experience in all other commercial real estate, having completed assignments in 40-plus states. His past projects have ranged from office buildings, regional shopping malls, industrial facilities, and various multifamily residential developments. And now, guys, if you've been in the industry for any time at all and have been involved in either park transactions that required a lender-ordered appraisal, or maybe you've attended any of our industry's national events that happen across the country, multiple of them every year, then there's a pretty good chance that you've directly or indirectly had interactions with Chuck. Maybe not, but he seems to be everywhere. I don't know. It's funny, though, because we haven't met in person yet, but we've talked multiple times and been involved in a few transactions together. But he seems to be everywhere. He's well known in this industry, and you definitely want to seek him out next time you're at one of the industry events. And so I'll tell you, I'm very excited to have a candid conversation with Chuck about a variety of industry-related topics. But before we get into it, I have a few quick housekeeping items I want to run through. First and foremost, this is something I tend to forget to mention most of the time, but just so you know, we're in deal acquisition mode here at Sunrise Capital Investors. In fact, we always are in deal acquisition mode. And the reason I make mention of this is because we're looking for opportunities to pay huge finder's fees for deals, for good opportunities. And so if you're out there on the hunt yourself, or if you come across something that seems interesting, yet you don't have the ability to take it down, please think of us. We've paid multiple finder's fees out over the past few years, and we'd love to put some money in your hand for a good opportunity. Additionally, we can come into a deal as a capital or operational partner, or both, if you have a lead on something that maybe you'd like to try to take down, but you just can't seem to do it on your own. Please reach out to us via our website. You can go to the Contact Us page at sunrisecapitalinvestors.com and just drop us a line, and we'll reach back out to you. Also, this might be a perfect way for you to get into the business, all while working with a group that has a strong track record like we do. Next up, we just opened up our second tranche in our Mobile Home Park Growth and Income Fund. And so if you're an accredited investor and you're interested in partnering with us on our own acquisitions, please visit our secure investor portal by going to invest.sunrisecapitalinvestors.com. You can find our PPM there and also our overall investment summary. You can download all our information. It's on a secure website. And lastly, guys, if you happen to be in the Tampa Bay area, I'd love to connect with you during your visit. Again, you can reach out to us through our website, sunrisecapitalinvestors.com. Just submit a message and I'll get back to you. And one cool thing is that if you make the trek and come visit us at our office, which is located in Safety Harbor, Florida, which is only about 20 minutes away from the Tampa International Airport. We're on the other side of the bay. I'll personally treat you to a tour of the Jacobson manufactured home plant that is literally 1 block away from our office. So it's kind of cool that we literally basically can get to see where the sausages are made right down the road from our office. So if you've never seen a mobile home park being made from basically the frame up, you come visit us at our office here at Sunrise, and I'll treat you to lunch and take you down the road here and show you how, again, how mobile homes are made, again, from the frame up. So, guys, without further ado, I'd like to welcome Chuck Schierbeck to the show. Chuck, how you doing today, my friend?
Good. Glad to be here.
Yeah, looking forward to chatting with you and talking shop. And again, as I'd mentioned, you and I have been involved on a few transactions together. We've spoken a few times, but never had the opportunity to meet, which is funny because we end up being at a lot of the same events, but our paths have crossed many times. We've done some business together, but haven't met yet in person. But you seem to be everywhere. You've been in the industry quite some time, longer than most. And so with that, what I love, Chuck, if you could, I'm going to kind of pass this back to you for a few minutes. And for those that aren't familiar with you, that don't know too much about you or your background, maybe take a few minutes, tell us a little bit more about you and how long you've been in this business.
Yeah, well, so I went to college, was a comparative studies major. I got married 3 days after I graduated, and worked in a variety of jobs. Initially, I was going to become a professor, but that didn't happen. I got a job at a bank. Then a friend of mine worked at an appraisal firm, and a position opened up there. So I started working there around 2001. My first focus was nursing homes. The person that I was working under at that time, that was what he was working on. And then in about 2005, I switched to a different manager and started working on manufactured housing. And I went, I would say back then, maybe 20% of what I did was manufactured housing.
Mm-hmm.
By 2007, 2008, it was getting a lot closer to 100%. And it is just about 100% now. I will do apartments at time. Some of the people I oversee do other types. I've got a team of about 4 or 5 people that range from being appraisal assistants, which is how you get into the business, to certified general, which is a step down from the top level, which is where I am, which is an MAI, which is a designation given by the Appraisal Institute.
Mm-hmm.
So I focused on that, and then the recession happened, and it was, prior to the recession, most of our business was CMBS lenders, commercial mortgage-backed securities. So they sort of, went belly up for a little bit. They're back, but they went belly up for a little bit, and we moved from the firm a group of us, there were about 4 or 5 of us, moved from the group we were at then to, it was at the time PGP valuations, but would eventually become Colliers. And so we moved over there, and they had a different client base, which helped us through the recession. And we started doing a lot of jobs for special servicers. And then, stuff sort of came back, and we've been going strong. We've been doing a lot of portfolio valuations in recent times. There's been a lot of consolidation in the industry, and we've sort of helped lenders get their hands around what's going on with those sort of transactions. So,
okay.
Sort of the arc of my career.
Yeah, well, that's quite extensive, and you probably don't have the exact number, but just to give us an idea of the depth of your experience. I mean, how many parks do you think you've appraised in your career?
See, the trick is getting, how many. Sometimes I'll talk about how many appraisals I've done versus how many parks, and that's because I'll do one multiple times. So, I know this year our group, and that includes, appraisers across the country, but this year, last year, 2018, we did 1,500, I think was the number.
Oh my gosh.
Yeah. And so I do somewhere between, on average, I'd say between 5 and 10 a month. So I've probably done over 1,000 appraisals of communities over the course of my career. Of manufactured housing would be my estimate. Yeah. Not all necessarily unique, but yeah.
That's incredible. What do you think, like over the last year or two, a couple of years, what do you think the actual ratio is of refinances versus, sales transactions?
I would say what I've done, it's hard for me to put an exact percentage. It seems like I've done about 50-50 at least. Okay. I've seen, I will do, for one client, we appraise their properties every year for their investors. So I'll do some of that. I know I just did a search to give you kind of the scope of sales. I did a search on CoStar. Well, actually, so we've got our database. We also subscribe to CoStar and Real Capital Analytics. Those are 3 data sources. Well, 2 data sources that are out there. And I'm sorting through, but I've got a couple thousand records of sales transactions over the last 3 years. So I pulled 2016, 2017, 2018. And I'm currently working on a sales report that'll show trends in prices and cap rates and stuff like that. But that's sort of, you're talking over the past couple of years, there's been several thousand of sales of communities. And that includes stuff, I think on the low end, I cut it off at 20 home sites. So all the way up to as much as there would be.
Let's talk about some of those trends. I mean, from the time that you started in this space doing valuations in the MH space to today, obviously we went through, a pretty significant downturn, the Great Recession of 2007, 2008. And so you kind of, you were in the space leading up to that. You went through that. And now, one of the biggest and longest run-ups in history is where we are today. And so generally speaking, what are some of the big changes that you've seen take place in our space?
Well, we have a 10-year cap rate chart that I'm currently working on updating. Send me an email after this, and I will send you a copy of that chart that you can post on your site. But so before, things were going pretty strong before the recession, and then cap rates went pretty low, and then I want to say 2009, 2010, things started coming down in terms of cap rates, and for those out there, capitalization, for the newbies, capitalization rate is the ratio between the income, the net operating income of a property, and the overall value. So, if a property has, 100,000 in income and it's worth $1 million, then it's a 10 cap, just for simple math. So cap rates, I can't remember exactly what they were back then, but I do remember during the recession, there's one specific property in the Grand Rapids, Michigan area. I appraised it at like a 7.5 cap in 2009. And I was asked at a convention, what was I smoking? I mean, how could it be that low? And that property then sold again as a sale. I can't remember. I think it sold at a 6.75, and I just appraised it again, and it was at a 6 cap. So there has been a lot of big money coming into the space, and a lot of people are chasing a lot of deals, especially in the quality investment space, right? Especially in the all multi-section, nice clubhouse, pool, your A and B class, 4 and 5 star communities. There's a lot of corporate money chasing these, and there are people that I thought would be in the industry forever, and they're still in the industry, but I've seen whole companies get purchased by larger companies, a lot of consolidation in that regard. So all of that has kind of pushed down cap rates. So.
Sure. Yeah, now, do you see like a lot of that consolidation, is a lot of that happening from an institutional source? I mean, at some point, it becomes very challenging when I've seen things trade in the, the sub 6 range or even the sub 5 range. Do you see that most of the buyers in those types of high quality assets are getting their source of capital from non-traditional means? I mean, maybe sovereign wealth funds or life companies. To me, it seems like they must have a lower cost of capital, correct?
Yeah. So there are equity investors coming into the space that have major factors behind it. A lot of, I mean, it's like Blackstone purchased into the space.
Carlyle Group, they're here.
Yeah. Those are names that I've seen on CoStar and in public. I know some other names as well that I can't reveal that's come into the space, and they're all institutional big time investors. So cost of capital for these, they're somewhat reduced. There's a lot of money behind these buyers, and they're well capitalized. So,
do you see, one of the challenges that exists in this space, and it is what it is, and I think it's going to change over time, is when you compare it to multifamily apartments, a lot of owners, typically even large equity groups, don't also in-house their property management arm, right? They outsource it to a third-party national firm that essentially handles the day-to-day property management of those individual assets. There are a few in our space that exist, third-party management firms, but nothing to the scale of what you might find in the multifamily space. And so it creates an additional level of challenge from an operational standpoint when you buy into the manufactured housing space. So do you foresee any kind of challenges in the long run with some of those, some of the groups that are buying larger portfolios that are, paying very, very aggressive cap rates? Because at the end of the day, some communities might, you might say that there's communities that are easier to operate than that of their brother multifamily apartment. But for the most part, I'd say when you compare apples to apples, there's some significant challenges in the manufactured housing space from a operational efficiency standpoint. Do you see that posing a problem at some point in the future where people are kind of diving in, putting all their eggs in, and it ultimately might not turn out how they originally planned because the operational side is going to pose some additional challenges to them?
Yeah. So, I mean, the challenge that, the challenge that sort of your traditional investors in the space, so the people that, some of these communities where somebody's father or grandfather built the community and it's owned in the second and third generation, the collapse that, little history, the collapse that happened in, the housing collapse that happened in single family residential that kind of triggered the recession, a similar collapse in housing finance occurred in manufactured housing space, kind of close to the time that I got into being an appraiser, 2001, 2002. There's a major lender of manufactured homes that, went bankrupt or stopped lending rather, which, limited the ability of people to sell homes. So people, in the 90s and 80s and whatever that owned communities, and the dealerships actually sold the homes to people and sent them to the communities and filled them up. That sort of pipeline went away. So what happened sort of in the 2000s all the way up to today is owners started to have to figure out how to sell homes in their communities, finance them, and do all of that. So owners have had to become more than just property owners. They've had to become retailers, lenders, things like that. Now, there are companies out there that will help you do that. I mean, there are lenders out there now, 21st Century being one of the major in Triad. And really, I guess that's a more recent trend is, 21st Century came out with the cash program, which is really, to me, that almost revolutionized the industry in a certain sense because people were so before the cash program came out, I was seeing absorption rates of one home site per month at best. Like somebody asked me to do 2 home sites per month and I told them they're crazy. The cash program came out and somebody was telling me they were doing 4 and I told them they're lying. They showed me their actual numbers and, I'm like, wow, okay. You've got the numbers to back it up. I'm happy to do this. And that's it's one of the things working in the industry so long is you start to develop, like general rules of thumb, like what I said, one home site per month is as much as it's going to be reasonable. Things change in the industry. You got to be able to adapt and understand what was going on. And that's one of the things that changed is, people are able to, I actually, now the question is, and this is something that I don't necessarily directly see because I don't value the homes and I don't really see under the hood in terms of what are people doing in terms of selling and financing the homes. So I don't know the entire how that all works, but the one case that I saw, somebody was actually leasing up at 14 home sites a month, which was way beyond. Yeah, they were offering 0% financing for 10 years. I did the math on it, and it was a giveaway of like my estimate was $10,000 per home site. So yeah, you pay that much of somebody's home, you tend to be able to sell the home a little bit easier. So it's how much you're going to get away to lease up your community. In that sense, yeah.
Go ahead. I was going to say, I think that's where, I think a lot of the risk comes into play. Maybe I'm just overly conservative, but we are set up with 21st and we've used them in a number of communities. And, I do think that there's underlying risk there, at least for the park owner. The park owner does guarantee the buyer. And so if that buyer defaults, ultimately the park owner becomes responsible. And, the fear I have in knowing what happened during the late 90s, early 2000s, the chattel crisis is, folks that weren't really qualified, just like that happened in 2008 with single family homes, folks that aren't overly qualified, aren't putting much skin in the game and getting approved for a loan that, should anything change in their life, whether it be, loss of income or, an event with a vehicle, they have to spend money to fix their car versus paying their home mortgage, whatever it might be, turns into a catastrophic event and defaults happen. So we'll see how it all plays. I do have some fear with the 21st program as far as default rates are concerned. And so for the most part, we're kind of going into it eyes wide open. And a lot of times we actually just will go in and let 21st finance us, and then we'll turn around and do a lease with an option to buy or something similar to that structure. That way we're not necessarily relying on 21st to qualify a buyer and only take 5% down. And which again, I do fear that if someone, it doesn't matter who you are, if you don't have skin in the game and it's easy to walk away when times get tough, guess what happens? You walk away.
Yeah. No, that's right. That's right. And definitely a better scenario to have someone with a significant amount of equity in the home. But and also the people that I'm thinking of that have done that program are also well capitalized with some of those equity investments we discussed earlier. So it's different for somebody that's like, a beginner getting into the space, wanting to do stuff, figuring out the right amount of risk versus somebody that's got, a deep pocketed partner. So,
yep, absolutely. Let's talk about, there's a couple other trends I wanted to bring up and kind of get your take on. One is the tiny house trend. And I don't know if the HGTV show is still around or not, but obviously that, there was a show that's been on for a number of years, if it's still on today. And I probably receive an email at least once a month, not too often, once a month, from somebody that is asking in one way or another about the opportunity to, whether it's they're looking at a community, it's got some infill and they want to talk about tiny homes and, asking kind of our feedback if we've done it, what's the demand look like, it comes in a variety of forms, these questions. And we have not participated in that space. We just don't, to me, it's very market specific. And we don't really own any communities in markets where I feel, they would have a significant demand for those types of homes, the very small 300 square foot footprint or maybe even smaller in some instances. But what have you seen as far as all the valuations you've done? Have you seen any kind of uptick with that type of trend?
I have not seen, on one level, the question is almost similar to a question, should allow people to put RVs on their lots.
Mm-hmm.
It's essentially some of these tiny homes, especially the ones you see on those shows are to me are nothing more than like DIY RV trailers. So, I mean, there are people, and we talked about this earlier with regard to some of the product we saw at the Louisville show. There are small, like Legacy Scott, what they're calling, one guy I talked to referred to it as a tiny home mansion because they're bigger than what
counterintuitive.
yeah, they're bigger than what your normal. To me, I walked into some of the spaces and they were also pitching them as hunting cabins. And, for that, if I was going camping, it's a very nice tent. I would be happy to stay in the space. I would look at, and I don't know what other product if I were to do that, I'd want a really good quality one because I don't, but I've actually talked to other owners that I know about this, and because there's actually in the 40s and 50s and a little bit earlier, there was what is known as park models. I'm sure you're aware of this. And they were smaller. They were like miniaturized versions of the homes that people could kind of demonstrate on. They don't. Manufacturers stopped making those, so you have a lot of communities where there are smaller sites that won't hold your traditional current modern trailers. So, the tiny home conceptually makes sense there, but I would want to have a home that was built by somebody in the industry. I wouldn't want someone bringing in their tiny home into a community just that they made in their parents' backyard.
Sure. No,
yeah.
Okay.
And I think it does make sense. Maybe you have a community with a lot of smaller spaces, or you could get approved by a local zoning board. I don't think that would be likely, but let's say you could. You could probably go to one of the manufacturers and say, "I've got 40 sites, and I'd like to discuss making a run of homes for these." With the right volume, if you were confident to sell them. Of course, I would want to have a big, deep-pocketed equity investor to do it, but you could probably find a manufacturer that would put those homes out there and put them on, but I don't see it as a major trend. I think a lot of times in this industry, if somebody's not comfortable doing something, they don't tend to do it. Like I know one major owner operator, and if we're talking about trends, I'll bounce off to a different trend. Up in Michigan, there are a lot of communities that are approved for, like, let's say they've got 100 home sites, they're actually approved for 150, and they have some surplus land in the back. Mm-hmm. So I know a lot of owners who've been in the space forever who would buy that but not develop out that space. I know other people that are like buying communities, paying a lower cap rate for that surplus land because they're approved to build out, because they're growing that strong. So if you're not built to dig up the dirt and put in the roads, you're not comfortable doing that. And the same thing goes back to the smaller homes. I don't think the industry is built for that yet. But the same thing I would say in terms of rental homes, which is another thing that's sort of shifted back and forth. Prior to 2012, the constant mantra I heard from everybody is people never do a rental. It just doesn't make any sense. And then I went out on inspections with owners that I know, and they're like, "Oh yeah, we started doing about 10% rental homes in our communities." So I think it's trending away from that a little bit, because you just have so many people. You have an affordable housing crisis that's pending in the country, and people will come and buy the homes and not rent them. So now, back off that, say it is a market by market basis, and you really have to, when you're getting into a market, you really got to understand sort of the mindset of the people in that market. So like right around that time period, I was appraising some communities in Dallas and some communities in Houston. Dallas communities had 0 rental homes. Houston communities had, I appraised some communities that had 100% rental homes. And we were trying to figure out how to do the valuation on the homes. So the Houston model was gangbusters. And, another thing is in the Carolinas, I know of an investor that has a bunch of smaller communities that are 100% rental, and they are doing, all the residents are also Section 8. Now that would make me very nervous, but the deal is that they are viewed by the Section 8 program in that state as a single family home. Mm-hmm. So you were able to get very high Section 8 rents paid for by the government, and they're doing very well with that model. So it's, the question is, with these different trends, what does my market want? And understanding that market is key.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my 2 podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers.
As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
Yeah, no, I agree with you. We prospect in a lot of different states, and I see very similar like state trends. Like there's certain states, South Carolina being one of them, North Carolina, actually both Carolinas, and then certain parts of other states like Western Virginia or certain geographic locations of Tennessee, to where there's definitely a predominance of rental homes versus resident-owned homes, and sometimes entire communities. Some of the southern states as well, like Alabama, I see it's quite common as well. And again, it's market by market, but the whole idea of not, I don't want any rental homes in our community. That business model doesn't work. I think in a perfect world, it'd be great not to have that model as part of our business, not have to worry about having rentals and having the normal turns that are associated with, a multifamily or apartment property or single family home rental, right? Because those people more than likely are probably going to turn every 12 months. You're going to turn at least 40 or 50% of your rental inventory every 12 months. Maybe not, again, market specific. But at the end of the day, if you want to fill vacancies in your community, and you've got that lower, smaller absorption rate. If you're only filling a couple home sites a year on the sales side, then you got to make a decision at that point. Like, do I truly want to fill this up? Am I comfortable with getting involved in the rental model, or do I want to go at a slow trot and maybe take 5 or 10 years to truly fill up this entire community? All the while, you're going to lose other people along the way. And then in addition to that, you've got situations where folks die, they pass, their heirs don't want their trailer. What do you do in that situation, right? I mean, I think that's a lot of times where folks end up with rentals. In a perfect world, you'd be able to gain title to that and turn around and sell it to an end consumer, but that's in a perfect world. You might have to succumb to renting. And I think that's a lot of what I've seen. A lot of the communities that we've purchased over the years that have a smaller percentage of rental units. That's basically what's kind of transpired is over the years, the owner never really liked rentals, but he had to deal with it. He acquired them, but for many different reasons. But a lot of times they were resident owned to start. And then over the years, they turned into rentals because people abandoned them, or, he didn't want it moving out of the park. So he bought the home from the resident so that they can move on, and again, turned it into a rental unit. And so it's interesting to see that trend kind of change, because I've only been in the space since 2011, 2012. And even then, just in that short period of time, there's been a significant change. And I know you go back way farther than that. And, back when you first jumped into the space, I'm sure the rental portion of the market was very, very small, right, in comparison to the resident owned side of the business. But, and
I think the perfect, the ideal thing is you've got a community trying to sell homes, be open to rentals, get your property filled up with whatever method you can, and then try and turn those rentals into owners. And that's from zero, that would be the model that I would take.
Yeah, and that's what that's exactly it. So we basically, when we bring new homes in, now we kind of have a plan to where we allot every every market's a little different, but on average, like we'll give, bring a new home in, we'll give it 3 months to try to find a qualified buyer that can come in and truly take that home off our balance sheet, right, and qualify for a mortgage. If within those 3 months that doesn't happen, we move to Plan B, which is a variety of a lease with an option to buy. It's many different formats depending on what state you're in, but a lease with an option to buy. Give that a period of time. If for whatever reason that doesn't work, which normally isn't the case, I don't think we've ever had to go from Plan B to Plan C. Plan C would be a straight rental, but for the most part, you can get someone with a lease option, someone that's looking for a lease with an option to buy much faster than you can get a qualified buyer that can go get a mortgage today. But so we kind of have that Plan B in place that allows us to continually infill and maintain that consistent absorption rate, and not just rely on folks that can, truly qualify for a mortgage. The average demographic that the manufactured housing space serves. I'm not speaking of the 4 and 5 star communities, just the the normal 2 and 3 stars. It's a lower end clientele. Folks that make $15 an hour or even minimum wage, and it's they've got some blemishes on their credit that have accumulated over the years, and getting a traditional mortgage or conventional mortgage is challenging. It just is. It's very rare that you find folks that have 600 plus credit scores that are in that 2.5 star quality park. And maybe you've seen a little different, but that's been our general experience. Yeah. So let's talk about, I want to hit on another point here, and I want to be respectful of your time, Chuck. I always like to compare our industry to the multifamily space. It's the next closest asset class, right? When you use a comparison model, and at least that's my personal opinion. And I do feel like the multifamily business is a little bit more advanced. There's a much larger sophistication as far as operators are concerned. And it seems like they're always pushing the envelope. And, there's been a number of trends that have happened over probably the last decade as far as creating additional ancillary income streams. A few to speak of would be like, pet fees, pet rental fees, not just a normal, pet fee when you move in, you pay one security, a separate security deposit for your pet. But now there's an actual monthly rent associated with you having a pet. Maybe it's $20, $30, $40 a month. Some of the other ones I've seen are like, boat and RV parking, what else? Power washing plans. This would be more in manufactured housing communities, courtesy trash pickup. And, so there's a litany of additional ancillary streams that I feel like exist in the multifamily space that I'm starting to see pop up in the manufactured housing space. Is that something that you've noticed as well? And then if it is, how do you typically value those additional income streams when you're looking at a property?
Yeah. Well, the major one is not necessarily a new one, but the major other income item is always utility reimbursement, right? So that is something, and that's actually there's a couple of companies that'll show up at all the shows that we go to, and they will help you convert your system to one that is friendly to recapturing as much as possible. And that, to me, that's the best thing to look at. If you're looking at the community, your first step is trying to figure out how you can switch your utilities over to a resident pay, because that's your utilities expense is going to be your highest increasing expense, or one of them. Maybe taxes could be another one, but so you'd like to figure out how to get that switched over. And I would recommend even, just to make it less harsh, saying, we'll go down $10 a month in rent, but we're going to switch over utilities, because that's a much bigger impact on you going forward.
Sure.
But the other stuff that I've seen, there are rental, one interesting that I've been interested in a variety of different property types. And one of the interesting ones that I've come across is co-working space, which is just an interesting field. But as I was thinking about it, I've thought at times, I wonder if you could, I don't think it makes a lot of sense for most communities, but I was talking with another owner, and, one of the trends in co-working space is what's called makerspace, which is where people can go in and build stuff and do things. And a lot of communities have maintenance garages, large maintenance garages that don't get a lot of use. Some of them, I think, were even originally intended to be able to pull in homes and repair them. I also see, and this other owner was actually complaining about this, thought that my discussion on this made sense, because he drives around his community around and has someone working on their car out in front of their home, which is actually a rules violation for his community. You might one potential idea is to take one of your maintenance things and turn it into a repair garage and make it a membership fee for people to work on their cars, or the power washing would tie into that as well. So if there's different aspects of your company or your property that make sense for that. I mean, if you have extra space in the back, self-storage, I think, is a natural thing, especially as people downsize, put in a row of self-storage units. If you're able to get zoning for that, if you're able to fence off some area, RV storage makes a lot of sense. I see RV. Most of it's just like an open field at some place, part in the community that people are allowed to park. Fence it off, improve it, and sort of do a pitch to the residents. Say, we see all your RVs parked in this area, and we've let that for a while. We want to provide better security for you. In order to do that, we're gonna put some fencing around this, and we're gonna charge however much a month makes sense.
Yeah.
Cost versus. So I think look at your go to Google Earth and take a look at an area of your community, drive around and see what most of these communities have some sort of surplus land that doesn't make sense as an addition, and you're not approved for it. But you might be able to go to your local zoning board and get approval for something like that. Some sort of additional revenue. In terms of how we would view it, in terms of the income stream, it depends how big it is. Mm-hmm. So, if it's not a significant portion, usually it's just another line item in the income portion of our pro forma. If it is a significant portion, it's possible that we would value that separately. We might apply a different cap rate to it based on trends. But I mean, usually it almost has to be like a 50-50 thing. Like you have two things, right? You have a self-storage facility and a manufactured housing community. But as a smaller line item, we don't typically separate it out.
Yeah. So. Well, the struggle, I'll give you an example. We recently underwrote a community that had, I think it had anywhere between 8,000 and 10,000 annually in pet income fees. And so most of these, but they're mostly resident-owned homes, maybe about 20% rental homes, but it is a monthly pet rental fee. And I guess the challenge with underwriting that is there's nothing stopping that person from selling their home and moving on. And what are the chances that the next person that moves in is going to have a pet, right? And so that income stream could go away at any given point in time, or as we know, pets die, right? They only live a set period of time. And what's to say that person gets another pet after their current one passes? So it's trying to determine what that value or that income stream is really valued at. I struggle with, and I could see the argument going either way.
Yeah. Well, so in terms of like pet fees and things like that, I look at history and see what they've done. I mean, somebody that has a dog. I mean, our dog passed away in October. We got two small kids. Christmas was a new dog, right? So people that own animals tend to replace them. So I don't see the pet fee as a common thing, though.
Got it.
I don't, and if it's in the income stream, I usually underwrite it.
Got it. Okay.
I mean, I don't underwrite, but I usually include it in the type. I mean, it will get put in. The one thing, like late fees and administrative fees, I usually go with history, but I really want it to be a small amount, right? Because if it's a large amount, then what's wrong with your community that everybody's staying late?
Yeah, right. I
mean, it's not that I don't trust the income will continue to be there, but ideally you'd hope that it wouldn't be because, it's money, but it's not a great thing either.
Yeah, so. It's interesting. I've had many conversations with some older mom and pop owners that literally will brag about everyone paying late, and it generates such a large amount of late fees on an annual basis. I'm like, I don't know if that's a good thing or a bad thing. That means that if we buy this thing, half those people might be gone. If they're really on the brink of not being able to pay that month, or it rolling into a 30-day late. So again,
at that point, you kind of ask yourself, are you a manufactured housing community or are you a check cashing place? I mean,
right.
It seems like the same risk is involved with those.
Sure. One other cool, and then we'll move on here. We're gonna wrap it up here. But one other cool thing I've seen, not many times, but it was an interesting additional income stream. Is they're fairly large lots, but they're mostly single wides, but they're fairly large lots. And this park owner, basically, a normal, I guess, a 10 by 10 shed, like a wooden shed. He basically rented them out. He had these things on like skids, so that he could literally drag them around the park and literally plop them behind any of the homes. And they're nice looking sheds. I mean, they weren't just like little metal boxes. I mean, they're legitimate sheds with shingle roofs. But he had it so where he could literally just drag them around on the grass with his tractor or whatever he had and plop it behind someone's house, and he would charge $40 a month, as an additional fee. To have that shed back there. And, us Americans, once we actually accumulate enough junk to fill up an extra space, we very rarely ever get rid of it, right? And so he had about 45 of those in a 100 space park. A significant amount of additional revenue. Those sheds probably only cost $1,000 or maybe $1,200. They surely weren't expensive, and they were probably 10 years old, so had been paid over and over again for themselves many times. I thought that was quite interesting, and just kind of throwing out ideas for those that are listening as maybe an additional income stream for your community, to provide storage or build an actual legitimate self-storage if you've got extra space aside from the park itself. But one last question I want to ask you, Chuck, before we wrap it up here for the day. Based on where we're at in the economic cycle, and I know you're not an economist, but you kind of are. I mean, to a certain extent, at least within the space. I mean, looking at values and trends and such. Do you see any big risk that ultimately might affect the industry in the coming years? And if so, what are they?
Yeah, so we are at the tail. Well, I don't know if we're at the tail. We might be in the middle. Who knows? But we're at part of one of the longest expansions in history. I don't know. We might be the longest since from now to the last recession. So me and my coworkers have talked, on and off about when the next one's going to come. So. And what's going to happen with interest rates going forward. So one of the ways we calculate a capitalization rate is we do what's called the band of investment technique. So you take the percentage, you take your mortgage percentage, usually 75%, you times mortgage costs, and you come up with the mortgage component of the cap rate. And then you do the same thing with the equity component of the cap rate. What kind of equity, cash and cash return people want. And that blended amount will get you what the total cap rate is. Cap rates are so low because you've got pretty low financing. Mm-hmm. So interest rates climb, you might see a little bit of a cooling. And I will say this to maybe anybody, any mom and pop that might be listening to this, now's the time to look to sell your community, because you're likely to get as good of a price as you can on the community. I mean, it's as good of a market to sell your community as I've seen. I don't know. I can't. I would be a lot wealthier if I could predict, what's going to happen. But I think there is some risk in increasing in interest rates. Mm-hmm. I don't know that it's impending. I think recently there was people thought it was going to go up and then it didn't. So there was a little bit of a stasis there. So. Yeah, I think that's a potential risk, but it's hard for me to put a percentage or quantify it.
Sure. Okay.
So my read on the industry and the strengths of it going forward is, and I'll look back to the last recession. So what happens in the last recession? A lot of people, we didn't see a big, people lost their homes. We didn't see a big spike in serving apartment occupancy or manufactured housing sales or anything like that. The reason was a lot of people were just moving back in with their families. Like, that was a big trend. It was, people that were the ugliest community that I've ever appraised was in the recession. And people were moving this property as a community of last resort. And they were eventually evicted from this community even. And when they did that, they would strip the homes of everything, and they were very angry going out. And it was understandable. I don't think that's going to happen in the next recession with manufactured housing, because we are looking at one of the biggest affordable housing shortages. If the economy goes down, people will probably move in with their family again. But I think you will see a lot more people kind of gravitating towards the affordable end of the spectrum. Is my take on it. So I don't want to say recession proof, but it is a good place to be in the event of a recession.
Well, at the end of the day, I like to use this argument as in any given market in the U.S., if you look at the the manufactured housing communities that exist within that given market, again, pick any one, it's basically, for the most part, the most inexpensive form of housing available. And if you truly can't afford to live in that community, then you probably can't afford to live anywhere, right? Unless you're going to go rent a room in a boarding house. There's really not many other cheaper options. And so if you can't live there, you're homeless, and again, that's not anything to joke about at all. But I mean, we really do offer the most affordable option of housing. And it's not the lowest quality. And in fact, most times it's the lowest cost, but it's equivalent to many B or even A-class apartment facilities, right? Depending on the grade of the community. So Chuck, this has been a lot of fun. I really appreciate you coming on the show. For those that want to reach out to you, connect with you, what's the best way to do that?
Best way would be LinkedIn. So if you just go onto LinkedIn and search for Chuck Schierbeck, and that's the last name is spelled Schierbeck, B as in boy, ECK. Do a search for Chuck Schierbeck. There's not a lot of Schierbecks in the world. I should come up as one of the. You could do Chuck Schierbeck manufactured housing. I'll be right there at the top. Connect with me. When I try and connect with somebody, I give them a little bit about how I hope to have the relationship benefit. Somebody that you're in the industry, you're interested in the industry, I'm very much open to connecting with people. I'll be happy to share information. We can start a conversation. I'd love to help people understand the value of their asset and how to make decisions within the space going forward.
Mm-hmm. Fantastic. Chuck, this has been a lot of fun. Thank you so much for coming on.
Yeah, it's been fun.
Guys, that's all we have for today's episode. But real quick before we say goodbye, I want to remind you of the free gift that we offer to all the listeners that take the time to go leave a rating for this podcast over on iTunes. And if you go do that, we will give you as a gift the exact cold call script that we use in-house here at Sunrise Capital Investors. And we do a lot of outbound calling. We do a lot of prospecting to park owners, and it's how we drum up a lot of our opportunities. And so I'd say we bought a number of communities last year directly from our cold calling efforts. The other ones are through brokers and also other direct marketing means. But cold calling should be a vital part of your business. And so if you're really looking to kind of take it up a notch, you should be picking up the phone and dialing. Here's how you're going to redeem that free gift from us. After you submit that review on iTunes, go ahead and send us an email to gift@mobilehomeparkacademy.com. Just tell us who you are and what your screen name was that you left the review under, and we'll go ahead and shoot that cold call script out to you right away. Also, you can go to our website, mobilehomeparkacademy.com, and you can download a free book that we give away. It's called The 21 Biggest Mistakes Investors Make When Purchasing Their First Mobile Home Park and How to Avoid Them. You can also listen to all the prior podcast episodes that we've recorded. I think we've got over 100 up there now. So hours upon hours of high quality content, just like we had here with Chuck today. And so really appreciate you coming and visiting us and listening into the show. And until we meet again next week, you guys take care.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.